This is the video demonstration on accounting for income taxes. In this video, I'm going to work the solution to example number 6. This example involves the Collins Company. They reported the following information for the year in terms of taxes, and this is the year ending December 31st, 2012. Total revenue, $2,340,000. Accounts receivable, $500,000. Total expenses, $1,670,000, and they're in a 35% tax bracket. Under the requirements, number 1, we are to calculate the income before taxes and the tax expense according to GAAP. Number 2, we're going to calculate the taxable income and the taxes payable according to the IRS. And then finally, on number 3, we're going to complete the necessary journal entry to record both of those. So initially, to do this, in terms of the GAAP accounting, I'm going to have a certain amount of revenue minus a certain amount of expenses. That will give me the pre-tax income. I'll multiply that by the tax rate, and that will finally give me the tax expense. So in terms of GAAP accounting, what's my total revenue? It's right there, $2,340,000. So I'll just simply plug that in. What are my expenses? According to this, $1,670,000. And what's my tax rate? They're in a 35% tax rate. So that's going to be 0.35. So what I'll do is I'll start off with my revenues minus my expenses. That gives me a pre-tax income of $670,000. Then I'll take that income and I'll multiply that by 35%, which is their tax rate, and that means their income tax expense will be $234,500. So that completes part 1. That is the tax expense according to GAAP. Now for part 2, I'm going to redo this, only this time it's going to be under the IRS rules. I'll have revenue again, expenses, that'll give me the taxable income, and then I'll have the tax rate once again, and that will give me taxes payable. And notice how some of this terminology has changed because this is terminology according to the IRS. Now right off the bat, I want revenue. Here's where I have a little bit of a problem. The IRS sees revenue a little bit differently than GAAP. The total revenue is $2,340,000. But we had $500,000 in accounts receivable. Now remember, the IRS does not consider the account receivable to be income because we have not collected the money yet. So instead of using the $2,340,000, I want to use $2,340,000 minus the $500,000 in receivables. So that means I'm only going to use revenue of $1,840,000. And that's just the total revenue minus the receivables. And I had to do that simply because the IRS does not consider those receivables to be income. Now my expenses will be the same, $1,670,000. And my tax rate will be the same, 0.35 for 35%. So the revenue minus expenses gives me taxable income. The taxable income times the tax rate gives me taxes payable, $59,500. So that completes part 2. That gives me the taxes payable according to the IRS. Now for the third part of the problem, I'm going to record a journal entry. This journal entry is as of the end of the year, so it'll be 12/31. Now in this case, in terms of the titles, whenever I pay my taxes, that's an expense. So I'm going to debit tax expense. I'm going to skip a space and I'm going to go down here and credit taxes payable. Taxes payable is a liability. I owe that money to the IRS. Now here's where my labeling comes in handy. Right here it says tax expense, $234,500. So I'll debit tax expense for $234,500. Then look at this one. Taxes payable, $59,500. So I'll credit taxes payable $59,500. So see how part 1 and 2 feed into my journal entry. Now, I'm almost finished, but I do have a problem. Notice that my journal entry is not in balance. And I need more on the credit side to make it balance. How much more? I need another $175,000. And what is that $175,000? That is a deferred tax liability. Now, how do I know to use that title, deferred tax liability? Well, think about it. I really should be paying $234,500. I'm actually only paying to the IRS $59,500. That's because of those accounts receivable. So I'm deferring the liability $175,000 to a later date. The other way I can tell that it's a deferred tax liability is obviously it's on the credit side. So it has to be a liability rather than a deferred tax asset. If I ever do this and end up with a deferred tax asset, that would actually be on the debit side rather than the credit side. So that completes the journal entry, and that completes this example on accounting for income taxes.